the end of the year, and that means all of the 2025 next year's outlooks are starting to come out for all different types of investment asset classes. Here on the Gray Report, we're going to be talking about the best for multifamily and what the picture and the landscape for 2025 may look like. That's what we're going to be doing today on the report. So from Marcus and Millichap, we have Marcus and Millichap's 2025 multifamily outlook, as well as from the National Apartment Association, their 2025 apartment housing outlook. We're also going to be looking at different types, construction activity amongst home builders, a report from the National Association of Home Builders looking at, what are we building and where, specifically looking at different geographic types, suburban versus urban. And then lastly, RealPage, Department of Justice saga. Well, it's coming to a little bit of not maybe finality, but a little of conclusion with the Department of Justice dropping their case against RealPage. You've heard it on the Gray Report, us dogging the Justice Department for over a year now for pursuing their baseless claims against RealPage. What has changed? Only thing is an election. That should tell you all you need to know. Stick around for the entire Gray Report episode. Make sure you like this video and you're subscribed to the Gray Capital YouTube channel to stay up to date. All right, let's get into it. Welcome back to the Gray Report, joined again by producer of the show, Director of Communications and Marketing here at Gray Capital, Dr. Matt Bossnagel.
Hello.
Matt, how are we doing?
Pretty good.
Great to have you. Great to have you back, man.
Thanks.
Okay, so man, we got the outlooks. They're coming out. I know we're working on our own outlook that's gonna send shockwaves around the multifamily industry. But everyone is trying to position right now for acquisition strategy in 2025. Mm-hmm. Sellers, they're thinking maybe I'm going to launch my property out at NMHC, get a head start in January. Maybe interest rates will be lower. Maybe it means there'll be more buyers. But we also have all this dry powder on the sideline, ready to get into the market. And this idea that maybe we're going to see a ton of growth in a couple of years, maybe not this year, but now is the time to get the low basis. Means there's a lot of speculation. So again, everyone's pulling out the crystal ball. Mm-hmm. There's a lot of different forecasts, and we've got a couple reports here going over some of the different forecasts.
It's funny you hit the nail on the head, really, on what's missing from these two forecasts is investor sentiment. They kind of talk about it in a sidelong manner in this with a wonderful web live. What was it? Web series, webcast?
Webinar.
Yeah, webinar. Sorry. But you talk about that in this Marcus and Millichap 2025 multifamily outlook that you did last week. It was excellent. But I was hungry. I'm hungry. I want to know what the investors are thinking.
Yeah.
And even in the National Apartment Association, I think they were a little bit. They're not surveying the investors, but they're laying out some basic facts. It's up to us to interpret it. That's what I'm digging into right now. That's kind of the missing piece. And you can get halfway there with consumer and sentiment, but I'd love to know what investors are feeling. My thought is they're feeling a little bit better now than they were last year, and maybe a whole lot better. But.
Yeah, well, first off, it was a great event last week. I had the privilege, honor, I was asked to sit on the Marcus and Millichap 2025 multifamily outlook panels, myself, two other individuals that are very active in the multifamily acquisition space, owners and operators. And so you're asking about investor sentiment.
Yeah.
And so, outside, we can find some surveys that are out there. NMHC has an equity sentiment tracker. But I can give you the anecdotes of what we're hearing, talk to investors every week, every single day. We're investors. And so it's anecdote, but it's a pretty good sample size, I think. And people are excited. They're ready to deploy capital. They want to deploy capital into good deals, though. And this is what I said on the panel. Like, the appetite is there, but the appetite is not necessarily there for, whatever. Now, there are some cases to make that there's the basis below replacement costs. It'd be worth speculating a little bit because there's likely some cap rate compression and rent growth out there in the future. But that's a big question of, well, when is the future and what type of growth? If you get that wrong, you could be over your skis pretty quickly. But investors, they're looking for a little bit of like a North Star. And I think they're looking, folks like us, Gray Report, but other sponsors, to try to paint that path, but they're also seeing sponsors being a little aggressive, so they're skeptical.
Yeah.
What we're hearing, we have never had more calls and emails from current and prospective investors wanting a deal.
Yeah.
The folks we're talking about are ready for a deal. Again, they want it to be the right deal. They don't want to do any deal. Hear from family offices that they're ready to back the truck up. Now, for good deals, but I think what a good deal looks like is a little bit different today than it was a couple of years ago. So you're not going to get the yields that you were once able to achieve a couple of years ago, unless you really can just find some incredible off-market, one-of-a-kind opportunity. Because rates are still relatively high, rent growth is still relatively low now. But if you wait to start acquiring when rent growth is high, and we've gotten the all clear, it's going to be too late to get the low basis. So your overall total returns are going to be a little lower. So more of the return is shifted on the appreciation side right now than the cash flow side. We're cash flow investors, so that's something that doesn't always sit right with us. We want to see a balance. And there is still somewhat of a balance. It's just shifted more towards the appreciation side, given that cap rates have expanded in the last year and a half or so. And it's our belief, with interest rates slowly coming down, normalizing over time, not back to the crazy low rates that we saw in the last cycle, but normal cycle rates, and looking at the general projections of GDP growth, we should be kind of slowing down a little bit. We expect some lower rates, and with that cap rate compression, so we should get some upside lift on the back end. But that's a little speculative, and so you've got to be careful, and it's got to be right.
But in all, investors are more inclined to invest now than they were last year. Do you think?
Yeah.
Right deal. they're always looking for the right deal.
Well, here's the other thing. I think the wealth effect is I've noticed it a couple of different times the last several years. It's related to the stock market. It's related to single-family home pricing. But we've hit. I think the S&P 500 has hit its all-time high like 50 times this year. It's basically at its all-time high. More plus or minus right now. Bitcoin, same thing. Crossed over the $100,000 mark. Gold's up. Single-family home prices are up. So you have people that, if they already are multifamily investors, and they've made good decisions. They didn't go buy a bunch of risky multifamily deals.
When the stock market crashes, which is what everyone's predicting now, that it's like certain percentage of GDP or something, they're all going to flood into multifamily. That's what I
well, that's what they say, but then people get scared.
Yeah.
Because they see their net worth based on their stock portfolio go down. So what I'm seeing today is similar, which it is could be some cause for concern. I'm less worried about it because I think there's different dynamics in the economy going on. But at the end of 2021, like end of the year 2021, first month of 2022, similar environment of there's just a lot of money sloshing around. Now, interest rates were still very low at that point, so the money was literally still free. But everyone was peeking out their stock portfolio. People were hungry and looking for deals, and it seemed like people were just trying to throw money at deals. I'm not saying it's that extreme today, but as of recent, we have done a couple good deals. So I think we're riding the momentum from closing on a couple of good deals this year. And people were like, all right, I want to get on your next one now that I've seen it. But we're hearing more and more of people who are saying, hey, when is your next deal? I'm ready. I'm waiting for one. I'm ready to go. And again, I think it's that due to that wealth effect. And I mean, if you're trying to rebalance your portfolio at all, you're thinking about portfolio construction and composition, well, you're probably overweight your stocks at this point because they've increased in value. So if you're trying to let's say you're trying to do a 60 20 20, 60% stocks, 20% real estate, 20% bonds. Well, your stock portfolio all of a sudden is like 70%.
Yeah, that's kind of what it is interesting to, and it may need like a physicist to interpret the ups and downs of the CRE market versus the stock market, but it does seem like there's definitely like a delay. These things move a lot more slowly.
Yeah,
in
the stock market
is
a forward-looking indicator. It's not always right, but I think also. I think that the election cannot be underscored. Just the the mindset shift that investors are having. The
Yep.
economy is already in a pretty good spot, and our base case was to be bullish over the next 5-10 years, with probably a slow year or two in front of us. But if we get tax cuts, if we get deregulation, and a general mindset shift that America's open for business, tax reform from 100% bonus depreciation, accelerated depreciation, again, that's not just good for real estate, but that's good for manufacturing, industrial users.
Yeah.
That means they're going to be buying big pieces of equipment, opening new factories, hiring more people.
Yeah.
And again, that X factor is probably going to keep a little bit of inflation around a little bit longer.
Yep.
But I see that all as upside, because if we do revert to more of a slow growth, developed economy, which I think at the end of the day, we are a developed economy.
Yeah.
With a lot of entrepreneurism and a lot of growth in the United States, there could be even more upside than what we had initially been projecting.
Yeah.
And where everyone is trying to quantify that right now. And so I had a conversation with
That's what I was going to say. They're all looking forward to appreciation. It's just like what level, and how can you be realistic without it's so tempting to overshoot it.
It can be, because you can make a really good argument that most of the deals that we're looking at, we're buying them for less than you could build it, and we're still 3.7 million housing units short.
Yep.
And we're not going to stop building completely after 2026, but we'll go back to decade lows after multi-decade highs. And it's hard to paint it with all this, with single family homes staying, the price is extremely elevated. Folks that would buy a home no longer can afford a home. All of the data points are pointing towards a robust multifamily market with steady, strong rent growth, strong household formation, and if we get a shot of adrenaline to the economy, next year, that's not a bad thing.
Yeah,
I mean, again, it may keep inflation and rates up a little bit higher for a little bit longer.
Yeah.
But our base case is rates kind of stay in a similar spot, because we're already seeing multifamily deals trade, closer to 5 caps, under 5 caps. So in many cases, the multifamily prices are not, they're not going back to 2022 levels, where every deal is trading for a 4 cap or sub 4 cap.
Yeah.
But they're kind of going back to 2019, 2020-ish pricing, in terms of cap rate, not price per unit or overall price, but in terms of capitalization rates, getting up to 5% or below, which I think is a pretty damn healthy market, and probably closer to where cap rates should be for some assets in some markets. So obviously, there's premiums, discounts, and others.
Yeah. Do you want to? I'm just curious about. There's a page 10 on this Marcus and Milich, and I'm not sure if we're totally allowed to share. I think if we share one page, I think we'll be fine.
I think but especially in front of Marcus and Milich app, get in touch with your local Marcus and Milich app broker.
That's right.
If you appreciate this. And again, shout out to the entire Marcus and Milich app team for hosting us. You can rewatch the webinar.
This is just a teaser, really. You gotta watch that webinar.
Yeah. No. The webinar was great. It was hosted by Peter Stanley, Marcus and Milich app, as well as John Shang. They're Senior Vice President of Research Services from Marcus and Milich app, and I was joined by the very intelligent Greg Campbell, who's a CIO acquisitions at Benedict Canyon Equities, as well as Zach Happenstall from Rise 48 Equity. What page, Matt?
10.
Yes.
And it looks at lending standards and mortgage rates. Basically, it looks like 5.6% for apartment mortgage rates, and lending standards that are gradually loosening, getting a little bit less strict, less tight. But mortgage rates is a little bit more up in the air. That it seems like the near term we've taken a little bit of a dip. We've dipped about, what do I have here, 30 basis points from 4.4 to 4.15 in the past month. Now, will it continue in the near term? It looks like, if you look at like the sub near term, since 2023, we've been hovering around like definitely above 5% for apartment mortgages, which is well above like maybe 1% or maybe 0.5% above the pre-pandemic norm. So interest rates are still elevated compared to where they are pre-pandemic, and there's not a very convincing story about them coming down anytime soon. And that's what I got on that. Now, relative to the peak, we're down for mortgage rates, and there's a lot more convincing story about multifamily loans. The lending standards getting a little looser, so banks seem to be maybe a little bit more confident. I think their confidence also plays into less. I wanted the webinar to be a little longer, talking about multifamily loan maturities. That was hinted at.
I'll talk about it.
I know you talked about it, but I wanted to hear more. I think that it's not going to be like a huge specter in the market, but it is like going to be an element that people shouldn't miss, and it could encourage more liquidity. Maybe not prices going down.
No, I think it's an inflection point to the decision driver. It forces a decision.
Yeah. So and I think that both banks maybe and apartment owners that are facing a loan maturity, loans come and due, you got to do something, right? That's the decision. Yeah. And banks are going to be more strict on that side, probably because they're like, well, economy's good. Like it's not going to be a disadvantage to keep this on my books. Kind of. Does that make sense? Like and also for the apartment owner, maybe it's going to be a little bit of a better market to sell. A little better than 23.
I think for some assets, what we were talking about on the panel is, and Zach brought this up, and it's a good point, is that the most distressed deals, and it's a lot of them out there, are deals that, like, who are the buyers for them? It's a lot of deals that no one really has interest in, and so like if there are no buyers, what does the bank do?
That was what I wish, if we could have just taken that logical leap. I was like, then sell it for lower. That's only possible. Or the banks take it, or they decrease. If you decrease the price enough, you're going to find a buyer.
But
it was kind of the unspoken assumption.
Yeah. I mean, that's true. I mean, like, who is that buyer at that very low price, and how low is that price?
Yeah.
It might be pretty low. And again, we're not talking about all multifamily, because there's obviously a huge demand for, call it, regular kind of normal C up to, brand new A-class assets, but it's kind of like the C- and below, where it's hard to insure, it's hard to manage, it's harder to finance.
Yeah.
Hard to get insurance. I think I mentioned that already.
I mean, who's
gonna line up?
I got an idea.
Who?
Get the price gets so low where it's cheap, where you practically gut that building and rebuild it. And that's and maybe that's where you're at, but I don't. Yeah.
There will be buyers that emerge, because I think at some point, to your point, the cash flow will be attractive enough, and the problem will be profitable enough to solve.
Yeah.
But where do those prices and those assets drag down some other assets? Because if it's like, look, I'm going to go and buy some of this, pretty rough, like C- value add deals, but I'm going to cash flow, let's call it 10%, cash on cash year one, I can grow that rent. Yeah, it's tough. Yeah, I have evictions. Yeah, there's turnover, but like, it's a cash cow. Well, the brand new shinier property down the street, probably will have a better chance of appreciation. It's going to be easier to manage. But if it's only throwing off 3, 4, 5% cash on cash, like, that's not going to necessarily meet all of the return objectives to a lot of investors. So there's going to be some demand, and that may drag down even the prices of some of the higher end assets. But we're going to have to see about how divergent they actually are.
I'm curious about, it was mentioned, I think, and there was a wall of maturities in 2023, and there was in 25. We've talked about this, a couple of weeks ago. Whenever we bring this, is this a boy who cried wolf situation? I think that if you think about the conditions now versus then, there's a lot more reasons why apartment owners would want to sell, maybe have to sell. The pain continued, and it probably will continue in 2025 in terms of like rent growth isn't going to be amazing to get you out of the hole. And banks were willing to grant concessions then, when now they kind of have guidance that like maybe they shouldn't.
What's going to be interesting is, because every broker is telling every seller right now, is that like next year's gonna be a great time to sell because rates will be lower.
Yeah.
And the prices will be
Yeah.
good.
Yeah. Yeah.
But what if rates aren't that much lower and the prices aren't that good?
It would still, I think, be a better situation than the pricing in 2023. Maybe I don't know if that. I don't know where the exact bottom of the market was. Like, I can't offhand, but like that moment in October.
In 2023, we could survive till 25.
Yeah. But now,
What is it?
If it's already
until 2020.
Yeah, like how long can you survive?
There's no rhyme.
And my point is as that time progresses, it gets more tempting to get more motivated to get out.
You get more motivated to get out. You're just like, cut our losses. Let's get a little bit. If we can get any money back, let's get a little bit of capital back, or let's just cut it loose. Or the lender is going to say, hey guys, we got to cut this one loose.
Yeah.
Sorry. Yeah. You guys are going to take a loss. We're hopefully going to try to minimize our loss.
Yeah.
And I don't see banks taking things over. I see them, forcing sales, and maybe taking over only to sell it.
Yeah. Okay. That makes
most likely
sense.
telling folks, hey, stick around. We're not going to go after you and sue you for more, but you need to work with us through the sale of this asset.
So that's just something that like is kind of hanging over a lot of the outlooks here. And in some places it's more explicitly stated than others. I think that there's a relative certainty that interest rates will remain fairly elevated. Like it's not going to go plunging anytime soon, but there is within that band of maybe like 4 to 5% or something like that. Like it gets pretty shaky. Who knows what's going to happen?
Yeah, and if the 10-year makes another run up even higher, then
like there's a period where like it's been bouncing around since like 2023 within this like 4% band.
3.5 to 4.5 plus.
Yeah. So if you catch on the right side, maybe that's great. But it seems like it changes every month.
And 4% seems kind of like a magic number on the 10-year Treasury to where if it gets below, it's 4% or below. It seems like deals can really happen, and above that, it seems to be much more challenging to get deals done.
Yeah. Very, very shaky. I still don't think that like we're in a. Just looking at the line graph, it doesn't seem like anything suggesting that rates are going to go hugely up or hugely down. It's just this bouncing around.
I agree. Let's look at some rent growth projection,
Yep.
Matt, if you don't mind just jumping around. National apartment rent growth returning to more typical levels as construction wave recedes. We're seeing a lot of the deliveries happening kind of right now. A little bit of trail over into 2026. And we're going to look at some other rent growth projections from some other sources and some good comparisons. But right now, I'm just topping the list, top 10 metros looking at 2025 average effective rent growth. Orlando takes the top spot. The top two markets are in Florida. Orlando at 4.5% year-over-year percent change rent growth, getting to an effective rent of $1,834, followed by West Palm Beach at 4.4%, Chicago, the first Midwest market on the list at 4.2%, followed by Fort Lauderdale at 4.1%, Philly at 4.1%, Boston at 3.8%, Washington, D.C. at 3.7. We got Miami, Florida at 3.6. And then two other Midwestern metros to round out the list. Indianapolis at 3.4, as well as Milwaukee at 3.4. The lowest rent on the list is Indianapolis, an average rent of $1,357 compared to the highest on the list, which is Boston, Massachusetts at $3,125. Wow, a month per your average rent. Man, Indianapolis seems like an affordable place to live, Matt. How is it to raise a family?
Yeah, we've been reading a lot about migration reports. It's pretty nice. For sure. Yeah.
Good.
Oh, yeah. I'm raising a puppy there. You might see it in the background.
Yeah.
I think there's lots of reasons, lots of signs that these Midwestern markets are growing, especially for people that are looking for more affordable housing. We've read like migration reports and this data that shows, well, part of the reason is lower cost of living. Now, the biggest reason is like friends and family and work, but cost of living is a huge driver. And when the rent is so much cheaper, that's great.
Those are a lot of thorough draws to bring you back, not just, from like dollars and cents and I actually can make a life here, but you also have family connections and roots or the ability to put those down, support systems. That is a big.
And here's something I was thinking of, like, what if there is like with remote work, what if you get paid like different different wages in different places. What if employers are more apt to hire someone in the Midwest because they don't have to pay him as much?
Yeah.
I don't know. Hey, they
Yeah.
could.
Yeah. Well, I know that, I mean, in the pandemic, some of that was going on because first it was like this geo arbitrage.
Yeah, yeah.
And then they're like, wait a second, what's your cost of living? You're not in San Francisco anymore. You're in Indianapolis. I think this is an interesting slide. The tides turn in 2025 as we see strengthened demand offsets abating new supply. And this is where they're able to project a little bit of rent growth across the nation, and especially in some of those markets that we just mentioned. But we've got supply that's really slowing down. Absorption and demand is surprisingly, shockingly high. And the pipeline is decreasing. And we're past that. We're past that point.
We'll see this in some more numbers from other sources in the National Apartment Association's outlook. Basically, starts are going down. It's very clear. Some of these predictions for supply next year are actually drastically lower than you'd think.
Yeah. And it's interesting, some of the divergence in some of those projections. And we've talked about this a handful of times, but I think it's important. I need to be reminded of it because it's so extreme. It's almost unbelievable. Affordability gap has widened. There's a significant barrier for loan qualifications for folks trying to buy a single family home. We're looking at a graph here, looking at home payments. So that's like your monthly mortgage payment versus your apartment rent. It's a third, almost a double, more than a third. Average apartment rent in the United States around $1,841. Man, that's expensive. Compared to your average mortgage payment, though, that'd be $3,000. That's a difference of $1,188. I mean, the difference is just a little bit below the average monthly rent in Indianapolis, Matt. And again, if you can see this graph, I mean, it was very tight in 11, 12, 13, and it was a pretty tight spread between your mortgage payment, and this doesn't count the hot water heater or the furnace that goes out or the roof you have to replace.
Yeah, but I've been thinking about this before. There's also like a bigger square footage that you get for a house. But the point still stands.
True. Yeah,
and
true.
The fact that that the gap was so close, before the pandemic, and now it's departed is a point in and of itself. But there are studies that take a home and then like the calculated like rent of the home, and they compare those, and it's like it's the same trend. It's the same trend.
It's a gap, and you may get more for your money. Or your money, you're going to get some more space, but I mean, if you can't afford it, it's not an option. And then now, share of households that qualify for a loan on a median priced home. This is what's dramatic. I mean, again, back in even 2021, I mean, just a little bit below 50% of folks of households could qualify for a loan. That's good. You at least qualify. Maybe it's not the right decision, but you can qualify. Now only 27%, in 2024, only 27% of households can qualify. That's more rental households.
Yeah. And that maybe explains a lot of where this is me referencing again the National Apartment Association outlook. Their numbers have housing starts for single family are not going to change too much. They may increase for some, like that. There's no dramatic shift. Multifamily housing starts are projected to go down with all these different sources, but it seems like there's so much about the single family home market that has been insulated from the interest rate pressures that otherwise, when it comes to multifamily, not so much.
Yeah, that's true. Would you like to look at any of these other slides, Matt, or do you want to move on to the NAA report?
Yeah, I kind of want to move on to this NAA report only because I've mentioned it so much already, and there's a lot of great stuff that I think is worth following. It shows different sources on the same topic, so it's not just here's our prediction. They show Fannie Mae, what's Mortgage Bankers Association thinking, what is Yardi thinking, so you can decide, and for every prediction I have my little take, you can take that with a grain of salt.
All right. Well, cue us up. Where should we start?
Yeah, let's start with the GDP forecast because they start with economic forecasts here.
Okay, economic forecast. Yeah, let's get everybody's forecast all in one spot. let's go.
And this is the demand driver section of your excellent webinar from Marcus and Millichap. You know, they talk about this. I think it is relevant. They say that GDP is going to be down a little bit, down about 0.5% lower on the whole, on average, amongst all these sources than their previous forecasts. I think that unemployment forecasts are more stable, actually, than that dipping GDP. Unemployment maybe ticks up a little bit, but not dramatically.
Yeah, all kind of in the 4.3, kind of low 4 range of unemployment rate. I mean, the Federal Reserve has a 4.4, Moody's 4.1, Fannie Mae 4.3, Mortgage Bankers Association 4.5, National Association for Business Economics 4.3. So yeah, pretty steady unemployment rate for 25.
Yeah, and CPI is actually even more promising. Like outright positive news there. Some of these have like, wow, what is it? 1.8 inflation. That's what Mortgage Bankers thinks we'll get to. Moody's has a 2.2% forecast, and all of them on the whole, like if you average it, it's like 0.42% is how much inflation will go down, or something like that. That's really great.
For real GDP.
It's nothing to kind of like scoff at here. I was looking at the CPI.
Yeah, CPI. Yeah, Federal Reserve has a 2.1, Moody's 2.3, Fannie 2, MBA 2.1, National Association for Business Economics 2.3. I mean, that's right next to the Fed's 2% target.
Yeah.
And so under those forecasts, which again, all the forecasts last year were pretty much wrong. So, big qualifier on all of this. But if that's the case, we would likely see a continued step down in Fed funds rate, as well as a kind of gradual reduction in treasuries as well, kind of getting that soft landing scenario. And there are some treasury auctions this week, Matt, that I want to pay attention to. Specifically the 10-year. There's a 10-year auction. I'm really curious. I'm going to be watching the level of foreign interest into U.S. treasuries, because again, I think this comes back to the election. Whether the politics don't matter. It's just the reality. If we see a resurgence of investment into the United States, and especially on our bonds, we could see those. We could actually even see lower rates faster, because one of the reasons for projected higher interest rates over the next 10 years is because foreign investors had largely kind of left the market, or especially China specifically. That could be an X factor that I'm not hearing talked about too much, but it's something that I'm going to be watching that could really get us back down to a surprisingly lower interest rate environment sooner rather than later. Again, that shouldn't be anyone's like base case, but it's just something I'm watching for to see if that happens.
There's a lot to look forward to in the economy. I think that there is. This. So my take then here is like the general employment trends that I've seen for the past couple of years are a little bit worrying. I'm not like sure if we're gonna. I'm not positive that unemployment is going to like spike up dramatically, but this is right now, we are in the middle of the longest period of gradually increasing unemployment that I can find on the graph. The caveat is like, we've usually when unemployment spikes, it starts to spike up really quick, and we could be at a moment where it just kind of hovers here and goes up and goes down. I'm not sure. I just think that the general trend, if you're pointing from like 2023 to now, is like a gradual increase. However, on the absolute level, we're still well below the 5% of like full unemployment. We're still like 4 something. So like, absolutely, yes. But trend, I'm worried. I'm still watching it. I've been not convinced to be that worried. It's not a panic moment yet.
Which is almost enough to cause a panic or cause for concern, just because, again, when it's all clear, it seems too easy. It's all up and to the right.
And that's what I've heard of this. What is it like? This ratio between GDP and stock market growth is like, now it's too good. It's been too good, and that'll be like the last words. Yeah.
I think we're okay. And I don't track the stock market as much as other folks, but I believe on a multiple standpoint, generally, the stock market is relatively healthy. It's just there's been some incredible growth of companies like, NVIDIA, and some other folks that.
And like that's like all this, and that's the thing is like I guess it's two sides to every coin. You kind of have to stick to what you know, because this stuff can get really general. You could say like the fervor of Bitcoin investment is that like that the signs before the Great Depression when it's like when the newspaper boys speculating, that's what I knew to get out of the market.
Yeah.
It's like so who knows, but I think that as it relates to the multifamily market, there's really good fundamentals here, and like I can't see any this like the demand driver. I don't think that unemployment is going to move fast all of a sudden unless there's this like a really big exogenous shock to the economy. But that's economic. It's a little more in my wheelhouse talking about multifamily if you want to move up there, but I did have a take on it.
Let's look at housing starts.
Yeah. So housing starts is an actually interesting breakdown that I noted before, especially the divergence of single family, which is up a lot more than multifamily. Multifamily starts, Fannie Mae thinks they're going down 1.8%. National Association of Home Builders going down by 5.8%. Moody's has them going up by 1.8%. And Mortgage Bankers Association down by 5.7. So the dominant here is that it's going to go down by maybe 5, 6, 4%.
For multifamily.
Yeah, for multifamily. Yeah. Now for single family, Fannie Mae does have a 0.1 or 1.2% decrease, but the home builders say that it's going to go up 1.3%. Moody's has it up by 9.1%, and mortgage bankers up by 6.6%. Clearly more robust building on the single family side. I just think that people will buy homes, and they're more excited about that than the multifamily investor who's looking at how much they have to pay in debt a little bit more closely. It's a little higher priority.
There's definitely still demand for single family homes from folks that can buy them. And for new homes, newly built homes, a lot of builders are giving away, teaser rates, or there's a lot of incentives going out to meet that demand. You kind of hear two different things. On the street, you hear folks that you hear people say that builders are a little bit nervous right now and they're having to create all those concessions. But then you also hear that they are still selling inventory despite.
Oh yeah, I did have something about
conditions.
this. Yeah. Thinking about it's just funny. Like people say concessions and like it's like you get free cable, but like, man, if you have a 5-year-old apartment and then apartment comes in across the street and they're giving away rent, they're giving away like 3 months of rent, then like how can you compete with that unless you really lower it? And like that's what's happening across the country, and maybe it'll happen through 2025, but it's just like it's worth noting how much of like a real effect it can have on someone and the capacity to compete.
If you're going to spend $2 million more paying your construction loan debt service this year, because you're on that loan, it'd be worth maybe giving away $500,000 in concessions to lease it up quicker to refinance in a half the time. So you end up saving.
Yeah. Oh man, that's a really good point. Yeah. And like also, they talk about supply here too. I appreciate you coming in on that graph there, because the supply, the diverging sources. So we're looking at CoStar, CBRE, RealPage, and Yardi. The big outlier here is CoStar, which had 677,000 is how much apartment supply this year, and then next year down by more than half, 335,000. I don't know. I think it's definitely going to be maybe somewhere in the middle between that. But all of these sources, whether it's CBRE, RealPage, Yardi, they have apartment supply, new supply going down by about 100,000, maybe more. Obviously, when it comes to CoStar, but
and basically a third. I mean, basically a third, less than a third of deliveries in 2026 compared to 2024.
Yeah, it is. It's stark, the drop off. I wonder if this drop off is really going to start to be felt in like the latter, like H2 or something, the second half. And because I think some of what we are dealing with as like trite as it may seem is like the backlog of construction that was happening during the pandemic. I know it takes about 2 years to build an apartment, but there was this backlog that got built over 4 years of high activity and starts that are still in some places still growing. But so I think that's part of the supply story. I just think that and this is where I've been really looking at. I've been looking at investor sentiment, but I've also been looking at specific markets. And you mentioned divergence, and the only thing about I was thinking a lot about divergence in the past couple of weeks as I worked on this. a divergence regionally, a divergence among markets, and how places like Charlotte, Phoenix, Austin, the common Sunbelt markets that had a lot of supply this year, new supply dumped on some of these markets. They're getting about equal or sometimes even more supply next year. So you think, oh man, it was so bad.
Yeah.
This is from the perspective of landlords. Great for renters. Renters had it great in 2024. They didn't have much rent growth. Maybe rent's gone down. They can move into a shiny new apartment, get free rent.
Perspective is different because if you're like the mayor of Austin, or you're talking about how, look, we're doing real estate right. We've allowed builders to develop properties, around Austin. We've brought in new supply, and what have we done? We've effectively lowered rent for our citizens, and we're most likely going to see lower rents over the next couple of years for the people, for the renters. Like that's awesome. Yeah. And that's where, like, sometimes we argue for less regulation and allowing for more building. That's going to mean we are arguing against our self-interest.
Yeah.
If we were only arguing for our self-interest, we'd say never build anything else. This is it. Landlocked. We want to build a high barrier so we can raise prices. But the reality, we need more building, and you can see the effects in Austin. But it's so true. From a landlord, it's like, I'm not going to be able to raise my rents for a couple of years. I might have to keep lowering it. For the renter, though, it's great news.
Yeah. But that effect is just as strong in 23 as it is in 24. In some cases, it's even stronger. They're going to get more. And this is after, maybe 2, maybe 3 years of incredible amounts of new apartments coming onto the market in these places. And they're just going to get more and more and more. Now, apartment demand is strong. Housing demand is strong, but supply can be stronger under a limited time period.
Well, that's what we're seeing right now.
Yeah. And
markets.
The beginning of this National Apartment Association report here, it said, what is it? I have the quote because I liked it so much. It says, it was not all about supply in 2024, which I kind of disagree with that.
Well, I thought it was an interesting way to start. Their outlook is basically saying, it's not all about supply. And then they basically say it's demand's we're talking about too.
Yeah, but everything's
which is true, but
everything's a second order.
And it's not like we're just having supply with normal demand, because that would be worse. And,
good point.
And to paint the whole picture, you have to say we're seeing unprecedented supply, but also pretty unprecedented amount of demand.
Yeah.
And that's just as surprising that it's able to more surprising that it's able to step up and meet those challenges of high supply, rather than see even deeper cuts and higher vacancy.
Yeah. That's actually something that's worth noting for sure, especially the absorption numbers. It's all right, so many more new people moved into an apartment, and I think those signs are promising and could continue well past the supply wave. And that's what I mean. On a limited basis, you could really hurt that. But on a long-term basis, we all know that 3.7 million households need more, or we're in that deficit of 3.7 million homes. So we're good on demand. We're going to need several years of this. It's just how it shakes out on the short term for all these different markets. But that was my big signal, is the places in the Sun Belt, they have this short term. There's going to be some short term pressure probably, but the places in the Midwest, maybe the Northeast, and other markets actually here and there they were stable. Didn't see a huge amount of building then, which is 24 and 23, et cetera. And they're not going to see a huge jump in building next year too. So that stability is really to their benefit.
Yeah. Let's look at some rent growth projections. I thought this was really interesting also. Basically, there's a little bit of difference of opinions, just the ranges of proposed rent growth. And so again, we're looking at CBRE, Econometric Advisors, CoStar, RealPage, and Yardi Matrix. So 2024, this is all fully baked, but we'll start with occupancy rate. Basically, we're right at 94.6 according to CBRE, 92 for CoStar, 94 for RealPage, and 94 for Yardi, with effective rent coming in at 0.6 in 2024 for CBRE, 0.7 for CoStar, 2.8 for RealPage, and 1.7% growth
I believe
for Yardi.
These are predictions for 2024. But that's the only caveat I want to give.
Got it. Yeah. Now for 2025, again, we can see some divergence with RealPage, basically marking the 3% rent growth, just about, with everyone else being quite a bit below. Yardi is a little bit below 2%. But for 2025, for CBRE occupancy rate, they're seeing 95%, just about on the dot. CoStar 92, RealPage 94.8, and Yardi at 94.7. So there's consensus around 95% except for CoStar, which is interesting. But in terms of effective rent growth for 2025, 2.6% is what CBRE is stating, a little bit below the long-term average. CoStar has it at 3.5% rent growth. That's a little slightly above the long-term national average. RealPage, 2.8%. And then Yardi, 4.8%. So we've got numbers anywhere from, basically below 40 basis points below the long-term average, all the way up to 180 basis points above the national average, according to Yardi. But where it gets even more interesting, Matt, is we go into 2026. Mm-hmm. And the reason is because this is where the question of when is all the supply going to come is be absorbed. When is it all, when's that overhang? I think, as you said, when is that going to be least delivered, absorbed, and then stabilize, and so we can kind of start seeing some growth, because then there's all of a sudden some scarcity of new product. So in 2026, we're almost done. CBR, I'm going to skip occupancy because they're all basically the same, 95, except for CoStar is 92. But in terms of rent growth, CBRE 3%, CoStar 3.7, RealPage 2.8, but Yardi Matrix coming in 2026 projecting 7% national year-over-year growth. Yeah, that is a lot. That's more than double what the two other projections, RealPage and CBRE, are suggesting. The next closest 3.7 with CoStar. Matt, any idea? I mean, again, we need to call Paul Fiorello to see what he thinks about 2026, and we know that there's a little bit of a divergence of opinions between RealPage and Marty and RealPage and Yardi based on where they think, when they think supply is going to come online. Is this the gist of it, or the crux?
It's got to be. It's got to be driven by the supply predictions. I think that it's notable too that they had the highest prediction at 4.8 for this year. So their effective rent growth was the high, and their effective rent growth.
They had one of the lowest for 24.
Yeah. So for 2024 it was below RealPage. It was 1.7 though, which is nothing, which is not like huge, and it's it's within spitting distance of what actually is, and that's something to note too. Like RealPage, they predicted 2.8% rent growth in 2024, and now it is actually like 0.4%. So very much below. And in that way, the 2025 prediction looks like a little bit more optimism. I'd like to see how. I'd like to know why it's the same for 24, 25, and 26 for RealPage. Maybe they just think, for whatever reason, it's going to stay the same right around there. But all of them have increasing rent growth. All of them have increasing occupancy. So that's, I think that's a positive sign. At least there's no big surprises there, for sure.
Which is always good.
Yep.
All right, now, Matt, the National Association of Home Builders has their eye on housing. You want to make the jump?
Oh yeah, let's do it.
So I already did.
That's a really good segue, by the way.
The National Association of Home Builders, Matt, has their eye on housing. And so we want to talk about, for the third quarter, there's a new status quo for the geography of residential construction, ?
So I just wanted to know really quick here, and this doesn't have to be an extended thing like our outlooks that we just covered here. I've just covered like how different apartment markets are performing, but I'm always curious about how these sub-market types are performing, whether it's, and how they have here, how much building there's been, and how much for single family homes and for multifamily, and they're dividing it up. All right, how much are they building in the large metro core county, essentially kind of the downtown? What about the suburban counties, and what about smaller metros? How is their core county and their outlying county, and so on? So are we talking about the downtown, or the suburbs or the exurbs, or are we talking about smaller or bigger cities? On the whole, it does look like for single family, actually, there was a lot more growth in large metro core counties, which is more or less the downtown. Like sometimes it's not quite downtown, but again, closer to the metropole than the suburbs. And the same thing can be seen in smaller cities. When you're downtown there, it's a little bit more single family home growth, and then in the outlying counties a little bit less. Now the same cannot be said for multifamily. For multifamily, the difference was. I think that if I can remember correctly, the suburban multifamily was the leader there. There was the most building there, and I kind of think that makes a whole lot of sense. I can think of at least like 5 suburbs in our hometown that are growing super quickly, enough to get attention from apartment builders. And some of these suburbs are building up little downtowns that look like, just as downtown as the core county.
Just don't call them little downtowns to their faces.
Yeah, that's
just make this little downtown.
yeah, and I think there is. It does seem like there's like these aspirations to create a little bit more of a dense area, or maybe it's a natural growth and development of these outlying areas, and it's just like it just gets more dense. Property values are going to increase. It makes it's going to be more practical from a financial point of view, but whatever. I just think it's curious how this is developing, and it makes a whole lot of sense from us. And I think that I've heard you say this a lot, and you said it in the Marcus and Millichap Outlook. Suburban is where you're looking. I think there's a lot of activity there, and it does seem to align with this general narrative movement towards the suburbs. And maybe this is personal bias, but I felt like 10, 20-ish years ago, maybe there was this return to downtown and let's go back to downtown. At least in Indianapolis, it seems like we're building up the downtown.
Oh yeah, no, that was everywhere.
Yeah. And now it seems like there's a pushback to the suburbs. Hopefully not at the expense of downtown, but that seems like the larger narrative that multifamily is following, at least. So just thought it was interesting there.
Yeah, it reminds me of the Ben Folds hit "Rockin' the Suburbs"
Oh, yeah.
that came out when we were in high school, I believe.
It drove everyone away from the suburbs, and now
yeah, well, the suburbs were considered kind of lame and nothing going
yeah.
on, and kind of where you grew up, you tried to get out of to go to the big city, and now everyone's like, that did that, and now I would like a little bit of space and some privacy.
And what's interesting though, the suburbs that they're coming back to don't have the same character as the suburbs that they remember.
You don't have to make the sacrifice.
Yeah,
if you want walkability, you got walkability in the suburbs.
Yeah.
But without homeless people.
Maybe.
With
newer infrastructure, I would say too.
Yeah, new infrastructure and less homeless people.
Yeah. But some people like that as a kind of charm.
I agree. I think there's always going to be a draw to the true urban downtown core settings that have the social theater, including homeless people, which I agree is definitely interesting. And why I don't mind downtown.
Yeah.
I carry a gun, man.
That's funny. I think that So it's interesting just to see how stark this is too. And if you could scroll up just a little bit, they have the multifamily construction market share in high density areas, and it's this line graph that is going down. And the same thing for single family construction market share in high density areas. The building is going down markedly from 40%. Now 40% to 36% isn't that much, but it is a very consistent pattern that happened.
And this is single family.
Yeah, this is single family. Sorry, the red chart at the very bottom of the article is multifamily, but it still shows a similar decline from maybe this push to build downtown, and now we're just now we're down from 69% to 60.
Oh, and I wish this went back even further. Oh, I guess it probably shows this peak here, which made sense. I mean, cool developers. I mean, developing in the urban core was the bee's knees. And it's where all the young people wanted to be. It's where they still want to be, by the way. The kids graduating from college are not all flocking to the suburbs. They're still looking to go to the big city and live close, live close to where they're going to work. Now, maybe that is in the suburbs now because a lot of those firms are moving, but a lot are still downtown.
Oh, and
You
even
can't
now,
get
like we're relatively downtown, a lot more downtown than the suburbs for sure.
Yeah, we're not in the suburbs.
And everywhere around us is like building up more and more. That's what I said. It's like it doesn't seem like it's at
not
the
zero
expense.
sum. Yeah,
of downtown development.
I would agree, and I don't think that there's. I mean, people were talking about our downtown's ever going to come back again a couple years ago, and now we're past that of like the downtowns have been back for a while.
Yeah.
Are they on that same growth trajectory? Probably not. But I think their kind of ankles got cut out from underneath them because everyone was like, "Oh man, there's a pandemic, and I need to have to get out to the suburbs."
It was nice during peak pandemic. We had our very downtown location, walking around just alone.
We signed in 2020 in like May, June, whatever of 2020, we signed an office lease downtown. Yeah. Talk about running in while everyone's running out, and we had literally the whole floor. Well, no, I guess we didn't have the whole floor to ourselves, but it was pretty much.
It seemed like we had the whole city to ourselves.
It seemed like we had the whole city to ourselves. Yeah, I mean, we were outside this awesome park. I mean, right downtown Indianapolis. Grab a scooter and do whatever we want.
It was very stark, and like it's a little bit busier. I still think that like it's not quite as crowded to put me off, but like it'll be interesting to see how much this shakes out. I have a feeling that Indianapolis was one of the cities that their downtown was a little bit more empty than others, but I don't know.
Indianapolis downtown, especially on the office side, did get hit hard because Indianapolis. I think there are a lot of people who are already living in the suburbs. Yeah. And some people were like, yeah, no, we're just going to stay up in the suburbs. Yep. But all right. So anything else on the...
Oh, no. I think that's about it. These segues are maybe...
well, I could have done a better segue for this. But man, something happened recently. It was an election. Then that's the only reason that I can imagine why the Department of Justice has dropped their investigation of RealPage and their investigation of multifamily rental housing pricing practices, so-called cabal or cartel of corporate price fixing and collusion. And
can I give a quick? I wrote down.
Give us the background. Give us the background, Matt. This sounds like evil corporatism right here. Why are the good, trustworthy folks at the Justice Department dropping this stalwart case?
Very good framing. Exactly what I needed. A quick explanation now. Fill in the blanks here. RealPage has software that recommends what landlords should charge for rent. Opponents think this is collusion.
Individual landlords.
Yeah, individual landlords. So you sign up for their service, and they'll tell you what rent to charge. This is very simplified. Opponents, they will recommend you what rent to charge. Opponents think that this software is collusion and that RealPage's software is kind of like a middleman that lets all the landlords on the block set the same high rent prices. That's like my my ungenerous interpretation of this dynamic here. And I've been really anxiously awaiting RealPage's comment. We had a guest from RealPage on, I think it was Carl Whitaker, when this kind of a few weeks on the other side, like after it kind of was announced, and we didn't talk about it, but it was in the air, and I know that
I don't think he was allowed to talk about it.
It could not talk about things during a direct investigation. But man, once it was announced that it's over, we get this press release, and one thing I do want to note here is this quote from the RealPage is that the DOJ never identified RealPage as a target of its investigation. So all this stuff, RealPage, all these headlines with RealPage and Department of Justice criminal investigation, no, they weren't the target of it, but they were just under investigation by the Department of Justice. I'm not sure whether that's 6 of one, half dozen of the other, but it does seem like, well, it wasn't. Maybe they weren't like.
They were mad at them.
Yeah. That's true. That's if they weren't the target, does that imply that they didn't have a kind of organized, formalized case against them, and they hopped off of that investigation at an earlier point than someone that may have been more guilty? Now that is probably the RealPage's perspective, is that like, yeah, you stopped because we weren't doing anything wrong. Now, I think your other perspective is probably equally right. That they talked
about it at the Democratic National Convention.
Yeah,
they talked about landlords colluding. This was
political.
part of the stump speech over the last year and a half that we've been seeing.
Yeah.
Is cracking down because in their mind, inflation is not the Federal Reserve's fault. It's not that the government spent a lot of money. It's not that we printed a lot of money. It's one software company that has a program that tries to find where the market price is. And they're trying to find a scapegoat to say, oh, it's not us. It's this company over here, because their constituents are saying the rent's too damn high and you need to do something about it. Inflation's too damn high. You need to do something about it. And they're saying, well, it's not our fault. It's the damn greedy landlords. And it's this damn scary corporation over here that's having all the landlords, which are evil, right? Yeah. Well, they're all colluding together. And it's a big evil conspiracy driven by a corporation. But we have no actual evidence or a case, so we're just going to make their life a living hell. Just the same way that the SEC has been doing to crypto companies over the last through the Biden administration. Like they're not necessarily breaking any laws, but they don't like it. So we're going to investigate you, and we're going to tell everyone that you work with not to do business with you.
Yeah.
What country? What is this? East Germany?
Well, so I think that there are certain elements of the case too, like. When you're breaking it down, it's like I think that RealPage in its response is actually responding to some of the what tenets or elements or arguments specifically in the overall case that's not just in the Department of Justice, but it is still under. There's still investigation for civil lawsuits from states, and some of the legislation that is being discussed involves things like, are you forcing people to take part? And RealPage says specifically, the quote is. RealPage revenue management customers, now this is their quote unquote algorithm, and customers RealPage revenue management customers always have total discretion to accept or reject pricing recommendations, and customers regularly exercise that discretion in practice. So if it punishes, if you don't take their recommendation, if it punishes you, I think that may be a bridge too far, whether it's legislatively or ethically. You? I don't know.
We're implementing RealPage AI-RM, which is their AI-driven revenue management, platform. Now that they've cleaned the data so where there's no, hint of using data that could be, colluding.
So that's another element too. Is what data do they use? Because this is just in the legislation on some of these things.
They can't use public. They can't use public data.
They can't use private data.
They can't use private data. It's all. Yeah.
And the other one is, are you punishing people for not doing a recommendation? Now there's articles out there that do claim that I was kind of not necessarily reprimanded, but there was some kind of negative consequence for them not following, like they got a call from the rep or something like that. They got a call
from the rep and it was like, hey, we're seeing that, we've got an opportunity here. Do you not want to take the recommendation that you're paying for? And you say, no, I don't want to take the recommendation. What are they going to, I don't
know. They called
What are they going to do?
I have such weak will. I'm just going to do what they say.
Well, and that is, I think a lot of it is that does happen because people trust it maybe too much.
So
you shouldn't have, you should be taking most of assuming that it's a good product, which hopefully if you're using it, you think it's a good product, you're going to take most of the recommendations, but you never want to take all of them.
And if the collusion,
just like any piece of technology, it's like ChatGPT, you don't just put in a prompt and just take it and put it out in the world.
Yeah.
You take it and be like, this is information. Okay. It's a tool to help, us align. And you build out what your goals and objectives are. It doesn't say rent in Indianapolis should be $1,500 a month, and we are using all. You're a part. You're just a node in our collective effort to move rent higher.
Yeah.
You put in: are you optimizing for occupancy? Are you optimizing for rent? At what level? At what rent level are you optimizing for? What is your availability? And then it allows to shuffle your leases around and manage your rent roll to say, well, we're going to offer, we're going to give you 4 different options. We're going to give you a 6-month, we're going to give you a 12-month, we're going to give you an 18-month and a 24-month lease options, all at different rates to move you around, because we actually it's been more beneficial for us if your lease ends in 6 months or in 18 months, not in 12 months, because we don't want you're signing a lease in December. We'd rather not have your lease expire in December. So we'll give you a better rate if you actually sign a 6 or 18 month. lease.
Well,
And it factors all that in,
yeah.
knowing all of your availability.
So there's like those options, right? And
Yeah.
so whether it's options or it's just one option, the idea that it would like RealPage is basically take it or leave it. Like if the people there had to play by the rules, that's the collusion. Like, right? If someone decides not to play by the collusion rules, that's really important for RealPage to keep them, in line. But they're actually responding to the market, and because they're responding to the market, it doesn't necessarily break their system if someone doesn't pay by the rules, and that's probably what allows them play by the rules. Sorry,
Well,
what allows them to
it's
give
not like
options.
there may be a market where everyone uses RealPage, but like it's not like every landlord is using RealPage or revenue management.
Yeah.
Maybe have, and I think the percentage is closer to 12% of like a real estate market is like using like a RealPage product.
Mm-hmm.
But like of those people, they're not necessarily using the revenue management because that's more expensive. That like your mom and pop landlord, if they're even using RealPage, is not going to be using the revenue management platform.
We did have separate discussions earlier. It was last week about the prevalence of RealPage or about the how many options do you have other than RealPage. Does seem like they have a clearly like they're the dominant company in the market. They've been really good at at building their tools and acquiring.
They do. But it's not like just property management. They want to be able to be like the OmniSource SaaS provider for landlords.
But there are others out there.
But there are many others out there that you may have to bundle a couple of other pieces of technology to do everything that RealPage, their portfolio of companies can do. But yeah, RealPage has been acquiring different prop tech SaaS companies over the last 10 years or so, and tying it into their offering with their base, like one site product, but they have CRMs and BI dashboard tools and revenue management. They have several revenue management tools. The AI, RM. We're doing an advertisement for RealPage right here, I guess, but they have multiple tools. They have performance analytics tools. They have investment management software, which we don't use. All kinds of stuff.
Yeah.
But there are tons of other property management softwares and systems out there also.
I just
Yardi,
think that
Strata,
if they were trying
Folio.
to move rather than like they're trying to move the market, it would be so it would mean that they're like punishing people to collude. Like if it really was collusion, it'd be super important for everyone to play by the rules. And the fact that there's not, the fact that they have options.
That's the whole idea of of colluding is everyone has to be in on it because it just takes one person to break.
Yeah.
And that's also assuming that the market can bear those high prices. That's what I would push back on is the market is where the market is.
We've got 2 years of proof that like RealPage, did RealPage set 10% rent growth in 2023 and 2024? No. And like the fact that maybe they are guiding rents, but they guided rents all the way to zero for the past 2 years. So to their credit,
in most markets, it's to help landlords figure out where the market is.
Yeah.
So instead of throwing a dart or just doing whatever you did last year, it gives you some indication of like, hey, if you're trying to achieve X amount of NOI, this type of occupancy, this is where your prices need to be based on your availability and where the market is.
Yeah, it's not trying to raise rents, and I think we've already figured out the best way to lower them.
Well, it might be trying to raise rents, but that's not illegal.
Yeah, it's not. Yeah.
It's trying to find where the market is. And it's not very different than other types of technology used in pretty much all other industries, whether that's agriculture, food, airlines, amusement parks, other essentials, again, medicine, food. So we get a lot of comments on the videos where we talk about this because people already have their minds made up on what they think of RealPage, what they think of
I think there was one
landlords.
maybe just last week about.
We get people. It's obviously non-investors who are making the comments, but they're not. We're missing something because we're bought and paid for by RealPage.
Yeah, I just
in fact
think that,
it's the opposite. We are paying RealPage.
Yeah. Well, I guess that's right. Hoping for a discount.
That would be nice.
It's not. I'm not as worked up.
In fact, we need to get that BI working. That tickets up.
I just think that like if you understand how the forces that we've seen, it becomes super clear that like man, apartment rents have gone down because of new apartment supply. Apartment rents have come down because the apartment next door is offering 3 months free, and people are going out and renting there because people make those decisions, and renters are making those decisions. And I don't think that the software, again, like the software is looking at the world and recording it, and then crunching the numbers and saying where you can get. It is not trying to have a vision of where it wants the world to be. It's saying you have to play by these rules. And maybe it is, and it's too subtle. But that's another thing too. Is like, I think that these algorithms, as much as RealPage might say, I think that they're maybe a lot simpler in terms of end result than you think. There is probably some nuance, but like I don't think that it is a super complicated like Westworld AI that we're dealing with. But that's just my 2 cents. Whenever I hear,
I also don't.
yeah. But
Yeah, no, I mean, like, yeah, it's sophisticated, but I don't think it's like it's extremely.
but maybe that's why they play it, because like now it's a selling point, right?
Yeah. Well, we Great Capital is an AI empowered investment platform. Man, did you not know that?
Not yet. I now newly discovered this. That's good.
But I mean, I could point to more than a dozen ways in which we've utilized AI.
Oh yeah,
in the business. So of course we're AI enabled.
Yeah,
everyone's AI enabled,
and that's what I think. Like,
we're great at AI. It's the next one.
You say.
Oh, Matt, we just raised $100 million. Sorry.
Oh, dang, that's great. And that's the thing too, is like I just have a problem with that like nomenclature, because it's like machine learning, computers do the number crunching and they make this prediction. You can call it AI, you could call it the computer give him doing this stuff. To me, there's less of a difference, and I think that it allows it is a veil of like not mystery but like intriguing and like enchanting a little bit. It's like, oh man, this is so complicated, I'm not gonna be able to figure this out.
Space age technology.
Yeah, that's kind of what it is. Yeah, so mystifying is what.
Yeah, no, we are going to be using more technology and tools. The LLMs are fascinating, very productive tool. Getting back to the macro economy, I mean, that's another big push towards productivity that I think we're actually going to start realizing. I think we already are, but I think we're really going to start seeing that show up
with agents and stuff, when they can do stuff rather than just type stuff out. And that'd be really interesting. There are things, if I could just have the guy move the same mouse every day.
Yeah,
but
even the typing stuff out is helpful.
Yeah. Oh yeah. No, I'm just saying, like, in addition, like once you can get these things to execute stuff, that's going to be really cool.
And some of those they're out.
Yeah.
So it's fascinating. We have not read past YouTube comments, and I want to do that today and go through their files. I mean, is it terrorism, drugs?
No, this isn't.
What's going on?
This is in connection, reportedly, with an investigation into RealPage for what they think is price fixing in the apartment industry.
I know a lot of the focus is on RealPage and some of the revenue management software, their pricing algorithms that make suggestions to property managers on where to set the price. What's the issue here?
They think that RealPage is telling all these rentals, increase your rents, and the landlords are clicking yes. They're not really thinking about it.
So using information and data to inform pricing decisions is illegal?
That's what they're saying. Allegedly.
I don't see the problem. And you think they even understand?
That's what I was going to say. It is based on a set of assumptions and misunderstandings about RealPage software and about the rental market in general that needs some updating. First of which is that rents have declined by RealPage's own data for greater than a year almost.
Why do they? Okay, so let's get into the comments. Please don't live in this is from Greater BV, Mr. Z. Please don't live in ignorance. This is all over the news and has been happening all over the S by institutional investors colluding with each other. Okay. Matt?
Yeah, I mean,
what's your any feedback for? There's a lot of caps.
No, I think that we kind of covered that. Like, RealPage isn't trying to force them to collude, and if they did, then it would only take like a few to really make a whole lot of money by breaking from the pack. And like, if you, I don't know, I feel like we kind of answered a lot of it in the video itself. Maybe this is one of those read the headlines and don't read the article kind of thing.
Yeah, I think they just kind of saw what it was about. Yeah. All right, so the next one. But that's this is by Cane Payne 0819. But that's not what's happening. What this company has been doing is much darker than that. What?
Well, we have a reply. I think you may have replied.
I may have replied.
Yeah.
What have they been doing that is so dark? And this is a different commenter. Manipulating the algorithm with false numbers should be definitely illegal, sir. At least we're having a cordial conversation. I don't even think that the Justice Department ever alleged that anyone was using false numbers or fake information.
Yeah. Well, no, but here I like the example that he gives because this is actually really, really useful.
Oh, yeah. Okay, sir. The reason the prices are up so high is because they are marketing less than they have to boost prices. Example, he has 40 units at $1,400, but the app will suggest selling only 20 for $1,800. While that's in play, the community starts to increase prices based on the average cost in the area. If the average rental cost starts to rise because of this, they have the right to up their rental property rates. This now becomes a chain reaction that isn't fair to the people and should be banned.
So I think that I think that what it is, I think first of all, I think it's valid. It's not a false number, but it's the idea of having of letting less apartments, renting out less apartments and charging a higher rental price. Whereas he is saying that what should be done is you should set your rents at a level that will achieve 100% occupancy. That's what I kind of am getting.
Yeah, and what's funny is like what he's suggesting is what the market does, and maybe it's not to achieve 100% occupancy, but 95% because you want some inventory to sell.
And that's where the art of the algorithm, arguably for me, that's kind of where the art is. It's not just picking the rent price, but picking that perfect balance of occupancy and rent growth. Like it is, that's where it can kind of get complicated. But I think it's a different way of looking at it than, all right, we want to fill this apartment up.
But let's do some quick math on
I don't think the numbers are really accurate.
It doesn't matter that they're not accurate, but it's to how extremely inaccurate, because it's a common trope that I hear is that landlords purposely keep units off the market. And generally landlords across America collectively are keeping units from the market in order to drive up prices.
And collectively, that's a good point. Yeah.
That there's some sort of collusion. And that's the whole argument here is that RealPage is having everybody collude to say you have 40 units, but I want you to keep that building not at 95% occupancy, but at 50% occupancy.
Yeah.
So he's saying to achieve a $400 rent bump on half of your units, but you're losing out on $1,400 for every single unit.
Yeah.
The math doesn't make sense. You know, the GPR of 20 units at $1,800, 20 units at $1,800 a month is $36,000. But if I had if I had 40 at $1,400, I'm at $56,000. I don't see what is he talking about? Why would I do that?
So in the RealPage,
just for a higher rent? Like I don't make money on the highest monthly rent. I make money on the total money I bring in. In
the RealPage software, do they say like, are you targeting for X amount occupancy?
You can do that.
Yeah. Okay. Yeah. So that's and that's kind of that's it, right? Like,
and you can have they have different products, but you can optimize based on your strategy. I'm trying to hit a certain NOI. I'm trying to just maintain. I'm in a lease up.
Yeah.
I'm in a turnaround value add situation.
RealPage is not providing all those concessions. Sorry.
No. Just again, like this logic. Like he's done the work.
Yeah.
Of trying to think it through, but he didn't think about what he wrote.
And that's the case too, right? The sacrifices would be too much for them to actually kind of collude successfully in that manner, I think.
And so we said, rental prices have declined for the past 2 years. How do you square that? And then a reply, what? Do you live in a bubble? Why don't you actually Google RealPage in the news? Not only do we Google it, we cover most of RealPage stories in the news.
Yeah.
Two men who like each other.
We covered this before.
We have. Okay, let's cover it again because we still haven't figured it out. Two men who like each other need to find why they don't like women.
I don't think we need to bring that into each other. I think we've got a decent rapport, and that's it, right? Yikes.
We are both married, by the way.
Yeah, we're Yeah.
This is such from Shane Smith 4170. This is such a terrible take on this. It is a price fixing cabal managed via third party software. RealPage is being fed information that if shared directly between the property ownership, they would be clear collusion in price fixing. They skate around that by offering a way for those companies to share that information via a third party, and then that third party price fixing for everyone's best interest with that combined information. This creates a non-competitive market where RealPage is able to dictate giant swaths of the pricing and basically capture entire regional markets pricing in their algorithms. You are all upset by this because if it is deemed illegal, which it should be, it has a direct impact on the bottom line and will force these property owners back into having to be competitive with each other. I did not realize the competition had gone away.
Yeah, that's why it's just frustrating to me. And like, I get actually like the standpoint from some people, because if you understand it on a certain level, man, it does look like we're all feeding them the price and they're just telling us what to say. But that ignores the fact that like we're building the biggest, we talked about it just 20 minutes ago, the biggest force in the apartment market right now is new apartments that are being built, not new algorithms that are being used.
No, it's a SaaS company, Matt. Figure 1008 videos. Figure you guys wouldn't understand.
Yeah. Oh, man. And the idea of using, this is the next one, they use proprietary confidential information to collude with other landlords to hike rents, tell whoever you paid you $100 for this joke of a video, their BS will come to life. Heart. I think, like I said, like that's another argument there, is that they're using private information. But a lot of this information is available, and it's a lot more available than it used to be. We could go on CoStar and get our estimates, and like I kind of said before, it's not magical either. Like it just can't move mountains, and I wonder if RealPage in their sales conversations, if they've got some guy that's like, all right, it's going to let me hike it up 200%, right? And they've got to like talk people down, and it's like, no, it's not the magic. It's not this like stark sorcery that is being depicted. It can't erase the power of new supply, let alone, whatever you're going to say there.
Very, very, no, 100%. It's the market that's going to be driving things, not a pricing advisor.
Yeah.
That doesn't control the market. All right, just a couple other comments. Just because we always say that we're going to get to your comments, I want to make sure we do get to everybody's comments. This is on our video, Apartment Shortage in the Making. Brian M. 8683, 96 billion multifamily loans with 79% of them holding a DSCR of 1 or less is alarming. Great info. Thanks for sharing. Yeah, it is wild. That's a lot of multifamily loans that can't service their debt. We talked about a lot of those maturities are going to be coming up next year. This is on our video when we asked ChatGPT. This is a good one. I've been hoping to get to this one, where I fed ChatGPT. I fed ChatGPT basically a deck of one of our deals, and I told it to grill me. Like I was, like it was a sophisticated real estate investor. You can watch the video, and I thought it was actually one of our relatively kind of our most watched videos, or it's a very popular video that we have, and someone doesn't think that they like it.
Yeah.
So their comment is, where does he get off giving people advice looking like that?
Oh, looking like that. Oh, I didn't see the looking like that. Like was that a dig at the way you look? I thought
I don't know. And then I would look back. I was like, what? How did I look? Was I too casually dressed, or what was it? And I can't figure it out.
I don't think that they meant to say looking. Maybe.
What do they think they thought? Where does this guy get off giving us advice
like that? Yeah, but I don't know.
On ChatGPT, or
that's another thing too. It was the AI that was giving the advice, right? I don't know.
Well, he was. I don't know. I don't know. But that was so Wiggles with Giggles. If you have any color to add, happy to get back to you. But I feel like I am pretty close to being a multifamily market expert. At least I play one on YouTube, and I was asked by Marcus Millichap to sit on their Outlook panel, and featured in a lot of media and articles related to the multifamily industry. We publish an organization that publishes research reports, puts out a weekly content or newsletter, podcasts, educational videos, and have acquired, over $1 billion worth of multifamily real estate. And we manage like $900 million of multifamily real estate. So like I know a little bit of own a property management company.
Not the least of which we've been doing this for 4 years almost,
Yeah, the market. Yeah, I've been in multifamily for basically
Well, I mean,
10,
this just the Gray Report. Yeah,
Gray
but
Report
yeah,
for,
yeah.
So, I mean,
No, I've been saying we've been putting us out there. You can look in our previous things if our takes are wrong. I haven't really seen a lot of comments that are like, you're way off base here. Now maybe they're coming in tomorrow, but like there's a lot of times where, and not to toot our own horn, but like we've noticed a trend or something, and it turned out like, oh wow, 2 weeks later, here come the headlines. That could be just following the same market as everyone else, but like that's largely what we're trying to do. Yeah, we're gonna give our insights, we're gonna give our opinions, but a lot of what we're saying here is just like, this is the state of the market. It's not
call it
hard.
like we call it the way we see it, and if we're not always going to be right, there's no way we can be right every time if we're doing this every single week, giving you our opinions. But let us know what you think. Drop a comment on this video or any future or past Gray Report video or any of the videos you can find on the Gray Capital YouTube channel. And if you're not subscribed, well, you got to be doing that as your next step. Hit the bell icon. That way, when we drop one of these saucy videos, you can be one of the first folks to take a view at it. And as I mentioned this last week, it's deal time. I think we got a deal coming up, boys. If you're an accredited investor and girls, but boys and girls, if you're an accredited investor, hop on over to graycapitalllc.com. Make sure you give us your email address, because we're going to have a deal. And honestly, Matt, maybe we don't need to publicize it. We have so much equity of folks who need to get in this next deal. We're probably not going to have room for anybody new. I always want to add new investors to the list, but we've got to make room for all the folks that have been with us on these last few deals. But just get in touch with us so you can start getting on the list to get access to all our deals. You got to be an accredited investor. And that's due to the SEC. And we're not fans of the SEC around here.
Oh, man, on January 22nd or whenever that is, those petty regulations will be a thing of the past.
If only we could hope. Cautiously optimistic on all of that. But get in touch with us. We'd love to have a conversation with you, see what your goals are for investing. Maybe it's the right fit. Probably isn't. Only one way to find out. All right. Have a good one. Talk to you later.